Afternoon, everybody. My name is Will Perry, and I am the presiding judge of Part 1 of the Shelby County Chancery Court. I've been here about 8 months. Before that, I was a partner at Butler Snow, where I handled commercial litigation for about 10 years. I'm really excited about today's panel. You're going to hear from 3 really excellent panelists about their experiences using unconventional methods for uncovering fraud schemes and tracking down fraudsters. You will learn how to advise your clients who may be facing similar issues. We want this discussion to be interactive. And so if you have questions as you hear the panelists presenting, please put them in the chat. I'll try to grab them and introduce them into the conversation. So our 3 panelists today are first, Jeb Bailey. Jeb is a partner in the Memphis office of Butler Snow and the leader of Butler Snow's bankruptcy and restructuring group. He's a fellow of the American College of Bankruptcy, a director of the Mid-South Commercial Law Institute, and a former chair of the Tennessee Bar Association's bankruptcy section. He works with companies and individuals in financial restructuring, business litigation, and bankruptcy proceedings. Our second panelist is Cindy McCauley. Cindy's a managing director in the forensics, valuation, and litigation support practice of DHG here in Memphis. She assists clients and legal counsel with a broad range of forensic accounting services, including fraud prevention and investigation. Last but not least, we have Nate Jones. Nate is a corporate financial advisor with Moglia Advisors, a financial and operational advisory firm that serves underperforming and distressed companies in Shelby County, the Mid-South, and across the country. Moglia Advisors professionals serve in a variety of capacities, including fraud investigators, expert witnesses, and fiduciary roles such as receiver, trustee, CRO, or assignee. So we're going to start with a question to each of the panelists. And I guess we'll start with you, Jeb, since I named you first. Would you describe what you consider to be the most unique corporate fraud scheme that you've encountered, and tell us a little bit about how that scheme was unraveled?
Sure. Like most fraud schemes, this one has a number of levels of complexity to it. That's one of the hallmarks generally of a good fraud scheme is to make it as complex as possible so that it's hard to detect and even harder to unravel. This one involved a gentleman who was running a farm implement dealership in the Mississippi Delta. And he had, and we'll call him Charles because his name was Charles. And he had devised this scheme where it was intended to defraud financial institutions, farm equipment manufacturers, vendors, and farmers. And it was not small amounts of money that were involved in this one. This one was a pretty big scheme. Each of these pieces of equipment ranged in value from $250,000 to $450,000, an item. So it was pretty large amounts of money in a real quick period of time. The way Charles concocted this scheme was he would go out and as a salesperson and visit with farmers around the South and kind of entice them to at least fill out an application to purchase a new piece of farm equipment. We represented a foreign manufacturer of agricultural sprayers. So it was a big self-propelled tractor that sprayed soybean fields and cotton fields and things like that. And so the kind of one, to give you like a real life example of it, Charles goes out to meet with farmer. He gets him to fill out some of the paperwork to at least apply for the purchase of one of these sprayers that cost about $400,000. What Charles then did was actually sign a lease on behalf of the farmer without the farmer's knowledge. And then he would take that lease to a leasing company that was run by a 26-year-old gentleman out of his house in rural Texas. And that guy would then go take that lease to a finance company and get the finance company to fund the purchase of the equipment, and then the lease payments would go for the farmer to the finance company, and so on. So what happened in this particular instance, Charles submitted the lease application and a delivery and acceptance form that said that Farmer A had received the sprayer unit. And once the finance company received that confirmation of delivery, it sent a wire transfer to the dealership, to the dealer that Charles was running, in the amount of $344,000. There were some credits for a purported trade-in that never actually occurred, of an old piece of farm equipment. And so the farmer was not aware that the lease had been signed, that the delivery certificate had been signed, or anything, or that the leasing or the finance company had actually transmitted funds to Charles and his company. And Charles never delivered a sprayer to the gentleman. And so at the end of the day, the farmer was on the hook for lease payments of $55,000 a month, and had no idea that he was obligated for this. One of the other interesting things was on all the paperwork that Charles filled out, he would make up fictitious serial numbers for the units. And that was one of the ways we kind of figured out what was going on once we became aware of what was going on. And so, it was for the purchase of a piece of farm equipment that had never actually been manufactured by the manufacturer. So how it unraveled has a different layer of complexity to it that's not really particularly germane to the whole scheme. But the equipment manufacturer had guaranteed the dealership's floor plan financing loan with Wells Fargo. And when Charles was selling these or obtaining these wire transfers for the purchase price of the non-existent sprayers, he wasn't.
Hey, Jeff?
Yes.
Hey, Jeff, could you please explain what you mean by floor planning, please? Thank you.
Sure. So in a floor plan financing arrangement, a dealership, more likely that you would be familiar with, would be a car dealership, will go out and approach a financial institution, Wells Fargo, Bank of America, and they'll obtain a large loan to allow them to purchase the cars that they have on the lot. And as the cars get sold, they are supposed to take the proceeds from the sale of the cars and use that to pay down their loan that they have with their floor plan finance company. So in this situation, the manufacturer had guaranteed the dealer's loan from Wells Fargo to the dealer. And when Charles would get the money for the purchase of these items, he would not use it to pay down the loan to Wells Fargo. He would use it to purchase real estate in Florida or an airplane or things like that. And so Wells Fargo then picked up the phone one day and called the manufacturer and said, "Hey, you owe us on this guarantee that the dealer hasn't been paying us on." And so we kind of at that point, the client went out and did an inspection of the lot there and found that there was not near the amount of equipment that was supposed to be there, and then started inquiring about where those things were. Charles provided a list of people that purportedly had this equipment, and when the manufacturer, at that point, they pretty much had engaged us, and we actually made some of the phone calls to some of these farmers, and they were unanimous in their position that they didn't know anything about anything and they didn't have any equipment. And so it was at that point that we realized there was a real problem. And so our immediate reaction was to file a lawsuit in federal district court in Mississippi, seeking appointment of a receiver and money damages and every other equitable remedy we could think of to try to at least maintain the status quo until we could figure out exactly more about what was going on. So again, a fairly complex situation to try to describe in 5 or 6 minutes, but that's kind of the crux of the story on this one.
Complex and terrifying. I mean, do you have any kind of I don't know, prophylactic measures that companies can take to avoid that? I mean, what's kind of the takeaway that people should walk away with?
Well, in terms of the discovering the problem exists, floor plan financing is a little bit of a unique animal, but it's not a whole lot different in the sense of any kind of secured lender situation where you want to know pretty much at all times where your collateral is. And so one thing to do is to make real certain you have adequate controls in place to know where your collateral is, reporting. Of course, to the extent that you're relying upon a fraudster to accurately report things, it's a little bit, that only goes so far.
might be a problem.
Yeah, it's kind of the trust but verify. You send me the reports on what you've got on the lot, that's fine. I'm going to swing by periodically to verify that there's actually 16 sprayer units sitting out there. The other thing is, and it's easier said than done. It's easier for the lawyers to look back on it and say this: don't ever guarantee somebody else's debt. That's always a good kind of rule of thumb, or at least know the person whose debt you're agreeing to guarantee. So run a criminal background check on them and those kind of things.
I had a question. What happened to Charles?
Well, Charles was indicted. He was picked up in Florida. Apparently was about to board a plane with plane tickets to somewhere in South or Central America, and so was denied, I think initially denied release on bond. The case eventually got transferred to the Northern District of Mississippi, and Charles ended up pleading guilty to one count of federal wire fraud, for which he received a sentence of 72 months incarceration and with an additional 3 years of supervised release, and then a restitution award of about almost $4.4 million entered against him. So that's I assume at this point in time, Charles may be repaying his debt to society.
Repaying his debt to society. That sounds right. That is quite a scenario there, Jeb. Cindy, what have you got? Do you have an equally terrifying story for us?
Before we move on, I wanted to ask one more question. How did your client end up, Jeb?
Well, like a lot of these, our client invested a lot of time and money in trying to unscramble the egg and figure out where things went. And the other kind of flip side of the coin is, while we were conducting this investigation and trying to figure out what had happened, Charles was over there creating trusts and LLCs in the state of Florida and transferring assets around from him to these LLCs and among these LLCs, and then going and using those properties to borrow money to create cash. I'm not sure why you wouldn't just keep the cash, but in essence, he, took $100, bought a piece of real estate, and then probably borrowed 80% of the value of that, which is what he could get a loan for. So at the end of the day, I think ultimately our client kind of came to the conclusion that they had spent about as much money as they were willing to spend, and they kind of left it to the, in large part, I think, to the authorities, and then kind of took what they, they'll get whatever they can get out of the criminal restitution award.
Did any of the creditors get out whole, or did everybody take a pretty big cut?
I think pretty much everybody took, our client was one of a number of manufacturers. There were also the leasing companies, and, I think everybody shared in a little bit of pain. I don't think anybody, maybe Wells Fargo came out whole, but at the end of the day, everybody felt some pain for sure.
That's all I had, Chancellor Perry. I'm sorry for cutting you off.
You are forgiven this time.
Thank you.
Cindy, have you got a good story for us?
Well, I think it's a good story. It's probably not the most crazy, unique story, but I picked a story that I thought could probably relate to, and hopefully they will learn something today that maybe will help them, clients, to avoid some fraud in the future. So my story is a young dentist. Our client was a young dentist, and he got out of dental school. I've kind of changed the names in all of my materials because I didn't want to get anybody in trouble, including us. So in this story, his name is Dr. Smith, and he got out of dental school. And at that time, there was a program that if you worked in like an underserved area, you could get your dental loans forgiven. And so he found a practice that a dentist had just passed away, and his practice was up for sale in a country area. And he was able to buy that, and that met the qualifications to settle his student loan debt. So this, the practice, he bought like all of the equipment, the patient files, and also all of the employees that were there when the previous dentist was practicing. And he was guaranteed that everybody was on board and trustworthy. The office manager had been there for like 20 years. And so, he bought the practice and goes about his, whatever dentists do every day. And one day, about 4 years after he purchased the practice, he happened to be standing up front at the front desk, and the mailman came in, and he was having a conversation with the office manager, who is Loretta Davis is her name for this story. And if I look at my paper, it's because I have to remember what I called all these people. But so she was up front, and he gets the mail, and he notices a check or an envelope from Chase Member Card Services. And so he opens it up, and it says, we are returning this check to you because we do not accept third-party vendor checks. And inside the envelope was a check that was written from Blue Cross Blue Shield, and it was written to the practice and to the dental practice. And then you flip it over, and where it says paid to the order of on the back, it had just an account number. And so he asked, Miss Davis, what is this? And I don't know if I mentioned this, but he had never opened the mail in the 4 years that he had been practicing there. This Miss Davis did everything from opening the mail, all the billing, all the deposits, everything. And so she, he's like, what is this? And she grabs her purse, puts it on her shoulder, and says, I think I better leave. And that was the last time he saw her until her criminal trial about a few years later. And so about a month after that, he received another correspondence from Chase on a different account with a different account number. And I'm not sure at what point he got an attorney involved. Hopefully at the very beginning, which is what we tell all of our clients, call your attorney first the minute you suspect something, because there's, we'll go over that kind of the end, but there's things that can be put in place if you kind of get ahead of the situation. And So at that point, the attorney called us, and our job was initially he had a small employee theft policy. So it was really to write a report to kind of explain the details to the insurance company and figure out what all was, that she has removed or stole, or whatever you want to say. And then, those can also be used for the law enforcement, if they want to prosecute. So when we first went to the practice, we started with the EOBs, which is the explanation of benefits that the insurance company gives back to the practice, saying this is what your charges were, this is what we're paying, this is what your patient owes. But what we found was there was a lot of those EOBs that were not in the files. And so that wasn't as helpful as we would have hoped. And so we went through those and picked out 14 different insurance carriers that this dentist received a lot of his payments from. And I'm not sure, this was a question somebody asked me yesterday when we were talking about it. I'm not sure really who contacted all those. I thought it was a dentist called all those 14 carriers and got them to provide the canceled checks and all of the explanation of benefits that went along with, what they had provided to the practice. So I take it as if it was an easy thing, but I really wasn't involved. They kind of called us when all the information came in and said, please do something with this and figure it out. So the canceled checks really helped us. The canceled checks from the different insurance companies really helped us because it would show us what all the different account numbers that she was sending things to. And she was paying her mortgage payment, she was paying her car payment, and about 7 different credit cards. And the crazy part to me is that, number one, and some of them were pretty reputable, Chase, Bank of America, like pretty reputable places. But, my guess is all of these big banks and credit cards have processing centers that who knows who's really processing these checks when they come in and letting them, be cashed. But they were for really odd amounts. It wasn't like an example would be the Blue Cross Blue Shield check was $343, and she'd write her mortgage payment on the back and send that in, and they would cash it even though her mortgage payment is $1,800. Like it just, and honestly, with her getting the mail, who knows how many times there was other ones that, came back that, that didn't go through. I don't know. So that was the one piece that she was doing is, writing to or sending these to these third-party vendors. And, once we got the information from the insurance companies and got all the account numbers, and we could figure out the routing numbers that were on the canceled checks that would tell us who she was actually banking with, because most of them just had an account number across the back. It didn't say Chase account number. Nate, you got a question?
I do. I wanted to jump in and ask actually Jeb a question about Cindy, your topic. Jeb,
Okay.
and Cindy, I'll ask you first. Do you know if the dentist pursued any recourse against the banks for cashing those checks?
I know they did work on that. I'm not sure on it. I feel like they did get some money back, but not a substantial, not what he was out at all.
Jeb, you think they might have a claim?
That's a great question. There's something about I mean, I think there's some presumption that after a certain period of time, you're presumed to have read your bank statement if you don't challenge it within a certain amount of time. I think you're kind of stuck with it. The bigger question I would have is if the doctor had, like some sort of employee, dishonesty insurance coverage or not. That would be.
And he did. He had like a small employee theft policy. It wasn't, I
Not
wouldn't say it
enough
was like 25,000 or something. Wasn't enough. I mean, it definitely helped, but it wasn't enough to absorb, all the things that she did.
Sorry to have interrupted.
Yeah, no worries. So that was one piece that she was doing that totaled about $140,000. But I was going to say one more thing before that, was that when we got the routing numbers and the checks, that enabled somebody to send subpoenas. And I don't know, again, if it was the lawyer or the law enforcement who sent the subpoenas, but they were able to send subpoenas to all these different, banks to say, give us all of your statements. So we could kind of see, number one, what was she spending her money on, and unfortunately it was junk, meals and entertainment and travel and some home improvements, nothing, some jewelry, nothing like substantial that he was going to be able to get, money back from. And so she was really doing what we figured out in the process is she was really doing two different things. One was sending the money for the third party, which was about 140,000. And then we also found another about 75,000 of what I would call upcoding. And so she would have a patient come in and they'd be coming in for a cleaning, $100 cleaning. And then when she would submit that paperwork to the insurance company, she would say, he had a cleaning and a crown. And so she was getting, money for basically fake services. And so the dentist he did a lot of the work on that to go back. He went through his calendars, went through the patient records to see, who actually, what service did they actually provide. But that 75,000, this was kind of an interesting piece. The 75,000 included over 500 patients. So when you kind of do that math, it's about $150. I mean, that's a lot of darn work for $150 a pop, like a lot of paperwork. You think some of these fraud schemes, like how they have time to really do their job because they're busy covering stuff up all day long. And so he ended up having to pay back some of those monies to, not only did he lose the money, but he ended up having to pay some of those monies back to the insurance companies for the services that didn't really happen. So, and at the end of the day, we did our report and she was 54 years old and pled guilty and was sentenced to 6 years of prison and 3 years of probation after her prison time was up. So I never like to see that piece of it, but I will say a lot of our fraud cases, it ends up that the business goes through all this and then they decide not to prosecute because maybe they don't feel like they can get anything or they just don't want the hassle. But in my opinion, that sends a message to, especially if you work for like a sizable company that these kind of things, everybody seems to know about it, whether you think they do or not, they end up knowing what has happened. And if, they say, oh, well, that person just stole $200,000 and nobody did anything to them, so maybe I'm going to try it. And so I always think that, prosecuting is a good thing, and that's my story.
I'll ask you the same thing that I asked Jeb. Is there a lesson, that companies can take away from that situation? Like, are there things they can do on the front end to, other than having like sort of the controls that Jeb mentioned, or are there other things that they can do?
Well, I mean, like in this situation, if he would have just opened his mail, that sounds like such a simple thing. You don't have to open it every day, but I mean, open your mail. I always recommend that business owners get a copy of their bank statements sent to their home. Because whether they ever open them or not, if someone, is thinking about committing some kind of fraud and they know that those bank statements are being sent to the business owner's home, then they might think twice about it. I'm trying to think another big thing that when I think to how some of our cases have gotten caught, making sure your employees take a vacation. So many times something is caught when that person who was committing the fraud is out.
Interesting.
I have some funny stories on that, but it's that's definitely, Alex.
Yeah, it's, I echo your, and I know Nate knows what I'm going to say next. I echo your concern about opening the mail. Suffice it to say, we have a client that for reasons of changes in management and the like, decided that in today's electronic world, all of our invoices and payments and bills would certainly come via email. So in the course of that management restructuring, no one opened the mail of a fully operating company for 2 months, because the assumption was it wasn't my responsibility, it must be somebody else's. And those somebody else's said, why open the mail when everything in today's world is electronic? And when we got appointed chief restructuring officer, which is to take over the management of the company, including changing all signature cards in the bank accounts to my sole signature, we began this novel concept of opening the mail and ended up finding all kinds of bills, disconnection notice, termination notices for insurance, any number of grenades. And people were stunned that we were talking about the pedestrian thing of opening the mail in today's electronic age. And we said, pedestrian or not, that's another way of checks and balances. So what you are saying is that neglect is alive and well in the business world. What you're saying, Cindy.
And I think it kind of comes down to segregation of duties too. Like what I talked about with this lady, she was doing everything. So whether it's you or you have somebody that opens the mail, somebody that posts the deposit, somebody that does the billing. I mean, sometimes it's hard when you've got such a small office. And if that's the case, then open the mail yourself,
I have to jump in on that too. That's a great point, Cindy. We have a fairly small firm, only advisors. But as trustees, there are certain things that as a trustee, you're obligated to do in your practice. And one of them is that the person that opens the mail must stamp the mail. And then Alex, you'll have to weigh in. There's something else about depositing checks. They can't be the person who deposits checks. Is that right?
Alex, you're muted.
It's the proverbial segregation of duties that we all know about. One person opens the mail, turns over that information to a second person who records that debt or the receipts or the bills. And that person or some third person goes to the bank and deposits it. In today's, if you have a large organization, you can segregate duties all day long. If you have a small business, as we all know, You may have a one-person business or a handful of people working there. The segregation of duties becomes much harder. But at the end of the day, the owners of a company, never mind how big a company or how small a company is, the owners of a company have an obligation. You can call it any number of obligations, fiduciary duties, to manage their business and not blindly trust on their managers, no matter how good those managers are. I don't care. It doesn't matter. If you're the owner of a business, well, it's privately held, publicly traded, the board of directors, the owners, the investors, the officers all have duties, and they need to exercise them. In Spanish, we have a saying, if you're running a business or running a department, as long as you're doing that, you only sleep with one eye open and one eye closed, meaning you can never take anything for granted in running a business. And if you do, you're setting yourself for a disaster sooner or later.
Agree.
Very helpful cautionary advice there, Alex.
Mhm.
Nate, have you got a unique kind of a corporate fraud scheme that you can share with us?
No, I'm sorry, we never run into that. I'm just kidding. Yeah, I've got a good one. I was engaged to assist a manufacturing company in reconstructing their books and records. They had entered into a loan agreement with a lender for $8 million loan. This was a private lender, so that's a pretty healthy loan for an individual to make to a company. When I got there, the balance on that loan was roughly $6.5 million, and it was secured. The lender's collateral was accounts receivable, inventory, and equipment, which is pretty typical of a lending arrangement for manufacturing. And so first thing I got tasked with doing was to validate the accounts receivable. The company's books showed they had roughly $4 million in receivables. And so I started taking a look at them, and it became very apparent very quickly that there was something wrong. I tried getting copies of bank statements from the owner. It took several weeks. It took 2 weeks to get copies of all the bank statements. He had bank accounts from 1 year. He had 13 different bank accounts. And they had started and closed down and started and closed down. He was shifting bank accounts every couple of months. And when you actually just looked at the bank statements, it became very clear very quickly. He had bounced checks, multiple checks every day. He had checks coming and going for the same amount on the same day. He was sending money back and forth with his mom for the same amount on the same day to get the float. They call that check kiting. But basically you're just transferring money around and using the delay from the banks to float money through. And the banks catch on to that fairly quickly. And that's why he was having to switch banks so often. So anyway, I realized something was wrong. He had not told me that any of this was occurring prior to me looking at the bank statements. And so it became clear very quickly that they had not reconciled their bank accounts in several months. They had not paid their lender in several months. And so we had kind of a big mess on our hands. And so in order to validate the receivables, I had to reconcile the bank accounts, started doing that. I could see where there were payments coming in that hadn't been recorded. And so we booked those against the receivables. So that 4 million total starts coming down some. And we got as far as we could doing that, but it still showed that there were balances. And so what we did, we took the next step to call these customers that apparently owed the company money and say, hey, can you tell us what you owe the company? And customer after customer says, we don't owe that company anything. In fact, that company owes us money. We've sent product back to the company and haven't received credit for it. And so we go through this for all their customers. And at the end of all of that, we keep subtracting from our accounts receivable total. The company actually owed $200,000 to their customers, where they were reporting to their lender they had a $4 million accounts receivable balance. And so we keep going. The owner of this company was not a pleasant individual. And so one of the things that I noticed while doing this was that there were certain invoices that appeared on their invoice register that didn't appear in their financial reports. If you added up all the invoices for a given period, they didn't match what was showing on their income statement. And so I took the 2 years worth of invoice register and plotted them out over time. And what I noticed was there was a big gap in the fourth quarter of the prior year. There was, in fact, if you looked at the financial statements, they had revenue every month, every quarter. But when you take the actual invoices and plot them over time, the entire fourth quarter of the prior year had zero revenue, none. And so that was odd. And I thought, well, why would that occur? And so I dig further and I dig further. And there's sometimes reporting you can get out of these financial systems that show when the last time a given transaction was touched by somebody in the system. And what I noticed was that all of these invoices that originally had a date in the fourth quarter of the prior year now currently had a date in the first quarter of the current year. And they had all been changed on the same day. And so I looked and I see that they're all changed on May 5th. And I think to myself, that can't be by coincidence. And so I'm just going to take a look at the former accountant's email and see what was going on around May 5th that might have caused them to do this. And so I find an email from their lender to the accountant saying that the lender is going to be on site on May 6th to look at their books and records. And so it became very clear what the fraudster had done was, in order to inflate not only their revenue for the current year, but they took all the open invoices from the prior quarter and moved them into the current period. And so now they look like current receivables, which are much more attractive to a lender. Old receivables often are not given much value by any kind of lender. And so by doing that, they had accomplished two things to deceive their lender. I also found that there were several large invoices that did not have the requisite detail. They were created the same day, by the way. They didn't have the detail that all the other invoices had. All the other invoices might say, you know, there's these products, this PO number, such and such. There's some large invoices that have no detail whatsoever.
Hey,
Well,
Nate.
yes, sir.
Nate, maybe you addressed it. I was taking some notes. Was there any kind of division of labor in that office where?
Good question. There were a couple of employees. Primarily, there was one accountant and one front desk employee who might bill invoices out. And so the transactions on May 5th that all happened at the same time had both of their signatures on them. So they were both working on this project together. And it just so happened to be that the person who worked at the front desk was also the sister-in-law of the owner of the company.
Wow.
Yeah.
Do you think she was? Do you think she was in on the scheme, or
Good question.
do you think she was oblivious to what was going on? And what was her role? And by the way, what were her duties? Just so I'll be quiet now and wait for you. Thank you.
Sure. What her role expanded over time as he couldn't keep accountants. typically accountants don't like to be engaged in this kind of activity. When you start bouncing checks all over the place and running up big balances, they don't want to be a part of that. And so he was having trouble keeping accountants. And so she took on more and more duties as time went by. Originally, she was just a traditional receptionist type, answer the phone, greet people at the door, maybe do some paperwork, but she ended up doing all their billing, doing some accounting, and I think she was depositing checks as well. So you asked if she was complicit. There's a term that we're using in a case, Alex. She was willfully blind, I'll say.
Which is a term that is used often in criminal prosecutions. And Nate is alluding to a case in bankruptcy court in Orlando where I serve as the trustee. And we see the actions of a bank and bank officers and insiders where everybody was willfully blind. It was like mass blindness. And we're going to be seeing if a bankruptcy court will allow us to pursue claims using that willful blindness standard, which is primarily used in criminal prosecutions for a civil case. So stay tuned. We may succeed or we may fail.
That's right. So to get back to this one, by the time I sorted through everything, this company had about $1 million worth of assets in old inventory, old equipment, to be able to secure this $6.5 million loan. And I brought this information in front of the owner and told him, I said, listen, I'm not going to be part of this. You're going to have to disclose this to the other side, to your lender. If you don't, I'm going to resign. I ended up resigning. He didn't want to fess up to it with the lender. And so I found out a colleague of mine, a good guy, stayed on to try and help them clean that up. And I found out that this gentleman, the owner, was my age, about 35 years old. He died of a massive heart attack 6 months after I left. You could see on him that he was carrying the weights of these burdens, these debts with him every day. He was drinking a lot, eating a lot, and it literally killed him. And so what that ended up doing was it brought all the creditors out of the woodworks. And so it was a small town, and you found out that he had been borrowing money from everybody, including his neighbor business in the parking lot. He had told the owner, she was one of the few that was smart enough to get at least a little one-page contract done. He told her that he was going to borrow $100,000 from her on Tuesday and pay her $125,000 on Thursday. She never saw a dime of that money. And all told, he owed all of his creditors about $12 million. So anyway, that's my story.
Now that you have thoroughly terrified us, Nate, and Jeb, and Cindy, and Alex, tell us, what can we do? You mentioned, Jeb, you mentioned earlier, like insurance may be an option. Cindy and Nate mentioned things like, pretty easy to do, like opening mail, segregating duties if your company is large enough to allow you to do that. Are there particular resources that clients can look for to maybe help them with that, particularly if you've got a smaller company? And so doing things like segregating duties or even like checking physical mail regularly might be more difficult than they sound. I mean, what can we do?
Sure, I'll start. One of the things Jeb mentioned in his discussion or his scenario, I'll reiterate, if you're lending money, you need to be keeping an eye on your collateral. A lot of the times when we come in, it's on behalf of lenders, or lenders are the ones that introduce us to situations. If they would keep a better eye on what's really going on with these companies, a lot of this fraud would be caught much sooner. And so that's one big thing. The second thing I wanted to talk about was, in my particular case, and any professionals, you attorneys on this call, same thing. Don't ever risk your own credibility for a client. It's not worth it. It's never worth it. We end up pursuing outside accountants, attorneys, directors, and officers because they're not willing to say no to their clients and walk away. And you just end up exposing yourself to professional liability claims down the road.
I'll add one thing I think that I did not mention before, something you said, Chancellor Perry, about these small places that don't have, one employee's doing everything. I always think it's, obviously the company has to make enough money, but you could get a small like bookkeeper, accounting person outside of the practice to at least like do your bank reconciliations. Like that's a pretty inexpensive thing. You could get them to do payroll, because just having somebody else kind of look at things. Like, I'm not sure if somebody did the bank reconciliation for this, my dentist story, that they would have caught it, because there was no checks that were actually going in the bank. That wasn't the problem. So somebody would have had it really been, well, honest. I mean, like I said, if you just would have opened the mail, you would have seen some things, but a lot of these fraud cases are actual checks. And so, doing a bank reconciliation and having somebody outside just look at it on a monthly basis, again, it goes back to, that might just deter somebody who is thinking about committing fraud if they know that somebody's, going to be looking at it.
Alex, in a second. Jeb, did you have anything to add to insurance or what you've heard Cindy say? Okay.
Go ahead, Alex.
All I was going to say is that what we do is not, the occult in looking at fraud, mitigating fraud, identifying fraud, pursuing recoveries. We don't do the unknowable. All you have to do is go into the internet and look at fraud prevention, fraud mitigation, keywords like that, checklist to processes to run your business, whether it's a lemonade stand or a publicly traded company. There are experts out there that do all kinds of security and fraud recovery, cyber attack prevention. It can get very super sophisticated, but if it's all basic vigilance of your business, and the trust but verify will forever be applicable as long as human beings are in business. It's not that difficult to have basic oversight, accountability, questioning what your employees are doing. Even if they're doing well, they mean well, they still may be doing something improperly, purely innocently. It's not that complicated to just be vigilant about your business. And to the lawyers, we're financial types, we parachute into all kinds of situations. Do lien searches, please. Please, that's one of the first things we do. Nobody does lien searches. We're the trustee in a case where $250 million were stolen, 38 financial institutions were fleeced, and they were so eager on the returns that the borrower, which started off as a legitimate company, kept promising them in the Ponzi-like format of repayments from borrowing, taking money from one to the other, that one piece of equipment, which was regularly retagged whenever an examiner would come for the number given as collateral to that one lender, it was constantly retagged over a course of about 10 years. One piece of equipment ended up being pledged to 13 different lenders, but nobody bothered to run lien searches. I mean, basic as it opening the mail. If you're in business, if you're in business and you're not paranoid, maybe you should choose another career.
We've got about 5 minutes or so left. And so let me selfishly ask, what can courts do? What can judges do in this scenario to make things easier? Say you've identified a fraudster and now you want to pursue a remedy in court. Are there things that judges do that make things harder? Are there things we can do that make them easier? For example, like appointing special masters in especially complicated cases. Talk to me about what judges can do.
I'll take the first crack at it if you want.
Sure.
For us, a lot of times, and I think Jeb, you spoke to this, and at least in your materials, a lot of times the speed of catching up to these folks is really, really important. And so if we ask for emergency relief or an emergency hearing, a lot of times that can make the difference in vast sums of money and real harm done. And so I would say the most successful cases we have judges who are very engaged and interested in what's going on and willing to hear us when we say we really need to move quickly on this and give us that emergency relief.
I'll brag a little bit on my own court. I mean, Chancery is really set up for that kind of expedited relief. Kind of the two big buckets of cases we hear are business disputes and family law. And a lot of the reason that we hear so many business disputes is because people come down here for injunctions to get immediate relief. But you've got to lay breadcrumbs for us because we've got very specific legal standards that we've got to follow to issue an injunction, which is usually the fastest way to get some relief. And what I think is frustrating a lot of times for lawyers and litigants is that, you're down here talking about money. And that is it's really hard to get injunctive relief when you're talking about money, because that's not irreparable. We have to consider, is the harm irreparable? And if we see any way down the road that you might get this money back later, it's really hard for us to say, well, we're going to give you an injunction. Even if we want to, even if it looks bad, we can, some lawyers are really good about, they've got screenshots of the bank accounts like hour by hour showing the money, leaving it. First there was 100, now there's 72. There's, but it's still money. And so you got to draw a breadcrumb for us to say, hey, and this is what that means. We're going to default on a loan after that, or, somebody's, I don't know. I don't know, but you gotta point us to something other than money, generally speaking, for us to be in a position to give you injunctive relief.
Yeah, would it's gonna shut down a company and cost people their jobs?
That's important, right? So that's definitely something we could consider.
Yeah.
But it's got to be more than a naked loss of money, right? Like, oh man, they're taking $10 million from me. As terrible as that is, that's the kind of lawsuit we hear every day and we can deal with in the ordinary course. But if it's now people are going to lose their jobs, and even if we recover it, it'll be 2 years later and the guy's judgment proof. And so even if we win, there won't be any money left, and then won't be able to give the people back their jobs. Those are the kinds of cases where we're really in a position to say, okay, we're going to freeze the status quo, let this thing sort itself out.
Thank you, Chancellor Perry.
So I think a minute left. Any last thoughts? Maybe one from each of you, Jeb, Cindy, Nate.
Your last comments were the ones that were kind of the most resonant for me, as a practitioner, is, you asked the question, what can the courts do to make, our lives easier? But I always kind of look at it from the other way and say, what is it as a lawyer how can I present my case? What facts do I need to present to make it easier for you to rule in my favor? And so, I think being prepared, having, really good proof, and having, engaging financial experts like Cindy and Alex and Nate to assist in the preparation of that is really critical. So I would say rely on your professionals.
I would kind of piggyback a little bit on that and say, for the lawyers, which is most everybody on this phone, on the call, most of them, to tell your clients, like explain to them what they should do if they suspect fraud, so they know what to do, like they know to call you first. I mean, you wouldn't be surprised how many people, like, they just decide to fix this on their own, and they start, oh, we're going to figure out how much they have in their 401k and what can we hold from their pay, and where they can destroy evidence. I mean, so much is like from electronic information can be so helpful for the case. Emails, and the longer you give them access to things, the longer they have to destroy the evidence. And especially if you've got maybe two people that are working together, there's probably going to be some email correspondence in there that is going to be valuable, or it might help you figure out who else is involved in it. And so, I mean, I would just take the time to talk to your clients on, hey, I hope you never have fraud, but if you do, I want you to know you need to call me before you do anything. Call, not me, I mean the lawyer. And you'll set them in the right direction to go.
Nate, we're over time, but give us your last thoughts, please.
Thank you. I'll be brief. Open your dang mail. It's pretty straightforward. Read your bank statements. It's straightforward advice. Alex mentioned it. Cindy mentioned it. There's simple things you can do that can avoid a lot of these situations.
All right. Well, thank you, everybody. Really appreciate your time today. Great panelists. I think you've got a note in the Zoom. The next session will start right in about 15 minutes. So we really appreciate your time today, and thank you for participating in this series.
Thanks, everyone.
Well, good afternoon, everyone. I am Judge Ruthie Hagan here in Memphis. I was appointed to the bench in October of 2020 prior to taking to the bench. I worked for Baker Donaldson in its Memphis office and was part of the corporate restructuring and bankruptcy group. They call themselves the CRAB group. With me today is Judge Denise Barnett. Judge Barnett is also a bankruptcy judge for the Western District of Tennessee. She was appointed to the bench in November of 2021, and prior to her appointment, she was a trial attorney with the Department of Justice, United States Trustees Program in Tampa, Florida. And then prior to that, she was an attorney in private practice in Jacksonville, Florida, where she represented consumer debtors, Chapter 11 debtors, trustees, and creditors. And then also with us today is Jill Niese. Jill is the managing director of Moglia Advisors, a financial and operational advisory firm serving underperforming and distressed companies in Shelby County, the Mid-South, and nationally. Jill and Moglia Advisors often act in fiduciary roles such as trustees, receivers, assignees, and are regularly tasked with pursuing litigation against directors, officers, outside accountants, and attorneys for breaches of their respective duties. And then we also have Locke Waltrip. She is an associate at Baker Donaldson in the Memphis office and is a member of the CRAB group, aka the corporate restructuring and bankruptcy group, and also part of the financial services litigation practice group. Prior to joining Baker Donaldson, she was a law clerk for Judge David Kennedy, who is a former bankruptcy judge, and she primarily represents creditors and other financial institutions in various bankruptcy and commercial litigation matters, both in Tennessee and Mississippi. And then last but not least is Susan Seabury. She received her BA and MBA from Vanderbilt and her JD from Georgia State University. She is a principal in Baker Tilly's Atlanta office, where she provides litigation support and restructuring services, and Baker Tilly's general counsel for its global forensic and litigation practice. Today, I just want to welcome everyone and welcome the panel and thank everyone who has volunteered their time to help facilitate this CLE, We are actually the last of, I believe, a 4-part series, and we are going to discuss a hypothetical fraud situation in which company officers, accountants, and attorneys may potentially incur liability, and the audience members will learn, hopefully, how to identify and avoid potential pitfalls, which could lead to otherwise unforeseen liabilities. And you can see on the screen is our hypothetical. It is a little lengthy, but I am going to read it to you and do my best. And then you could always just keep referring back to it. Or I believe it should remain on the screen as we start our panel discussion. So in our hypothetical, we have John Smith of Smith & Smith LLP, who represents Acme Widget Company as outside legal counsel, and Sarah Summers of Summers & Associates advises Acme Widget Company as outside accountant. Both have an ongoing personal relationship with Acme's CFO, Ronald Jones, and as they were all fellow high school newspaper writers, their children all go to the same school, and they share a suite at the Forum for the Grizzlies home games. Sarah, the outside accountant, also does personal financial planning and tax work for Ronald, Acme's CFO. In her review of Ronald's personal finances, Sarah notices several large deposits from Acme's largest supplier, Parts Plus. When Sarah emailed her inquiry to Ronald about the deposits, Ronald responded by email that he is doing consulting work on the side for Parts Plus. Sarah is concerned about a possible conflicts of interest, but is wary of furthering the conversation via email. So she brings it up with Ronald at the next Grizzlies game. In response to Sarah's inquiry, Ronald pulls both Sarah and John, who's Acme's outside legal counsel, aside for a private conversation. He explains he is doing some consulting work for Parts Plus on the side, and he has not disclosed this to anyone at Acme. He asks that they keep this information confidential for a short period of time while he figures out how to disclose the arrangement in an appropriate manner. Both Sarah and John agree to keep the information confidential, but recommend that Ronald end his relationship with Parts Plus and disclose the arrangement to Acme as soon as possible. 1 month later, John hears from Acme that Parts Plus sued Acme, alleging that Ronald used his influence as CFO over Acme's purchasing decisions to extort the quote unquote consulting fee from Parts Plus. And I know there's a lot here, and we have a panel of expert and women actually all on the same panel. So I'm going to go to, let me get my notes in front of me. I'm going to jump to Susan first and ask Susan what she believes, what should Sarah's next steps be, and explain your reason.
Well, when Sarah was at the Grizzlies game, she should have looked Ronald in the face and said, "Friends, do not put friends in collier carrier positions. You have until the close of business the next business day to come clean. If you don't, we have a problem." The reality is, if Acme Widget Company is publicly traded, Sarah has significant problems because she should never have taken the assignment with Ron in the first place. The Public Company Accounting Oversight Board, which was created as part of the Sarbanes-Oxley situation, where the SEC and the government decided that auditors were too friendly with their clients, promulgated a rule that says PCAOB Rule 3523, which says that you cannot provide, if you are the auditor, if you're providing attest services, then you cannot provide services to people in the financial reporting chain, which usually means most accounting firms won't provide services to anybody in the C-suite or certain other financial professionals. But the reality is that Summers and Associates is likely not doing a public company audit. So it is more likely than not that Acme is a either privately held company, is a smaller company, privately held. It is not unusual for the same accountant to provide audit, tax services to both the company and the executives, particularly if Ronald has any minority interest in a smaller company, particularly if it's a pass-through company, because You want everybody taking the same tax position on the same things. There's a reason Baker Tilly does my taxes for me. They don't want me to screw it up.
Susan,
That's
can
not
let me interject just for a moment. Is there a way that you can still represent all those individuals with a well-drafted engagement letter, or
Yes.
is there just a per se? Okay, please continue then.
You're engaged. The best thing that Sarah could have going for her here is a well-drafted engagement letter. If you're going to do all this, very often when I see them, they are all in one letter. Summers, you're going to do this, you're going to do this, you're going to do this. It talks about the individual's taxes. It talks about the company's taxes. Important thing to do is possibly disclose who does what to whom if there is a conflict. Usually there's no problem because everybody's rowing in the same direction. But Sarah has some other problems. Sarah's doing tax work for Ron. And there is not only a AICPA, which is who governs audits and behavior of the CPA. If it's an AICPA audit, if she's doing audit work, she should have gone through a whole procedure before she took this job to ensure she's independent. We hear a lot about conflicts checks when we do legal things.
Mhm.
Most accountants spend a lot of time thinking about independence because it's usually the accountants against, let's say, the IRS. They don't really think about conflict so much as independence. But if all she's doing is tax work for everybody, she still has a problem because there is a federal law. It is Title 26, Section 7216 and 26 Code of Federal Regulations. There are a couple of sections that prohibit you from disclosing confidential tax information. To the extent that she was doing tax work for Ronald, she can't tell Acme about it. The only thing she can do at this point is resign and do it loudly enough to make it clear there's a problem. In other words, a conflict has arisen. I cannot discuss the conflict, but I have to resign. And that's all that's her best option here.
And Susan, is there a difference between if she's doing audit work versus any other type of work?
Yeah, there
I
really
know you
is.
sort of touched on it, but
Yeah, audit work is, I mean, the AICPA and other accounting regulatory entities spill a lot of ink about independence, and a lot of thought is given to independence. If you're doing it's either called a test, audit, assurance, all the same thing, and it's a test. It's an audit, and your auditor is supposed to be independent. Now, the reality is her relationship with Ronald would probably be a problem if she were doing audit work. One of the risks that they talk about, the AICPA talks about as an area of threat to independence, is being overly familiar. There's a reason that when you're an audit partner, you get rotated on and off. You get rotated off after a few years doing the audit for a client, is because it becomes hard to remember who the client is and who the client contact is. And so they want to make sure that you are independent. And going through her independence checklist that they give you in the AICPA Code of Conduct, likely that would have been a problem, that she owns this suite with Ronald. That's probably a problem. So she probably shouldn't have been doing audit work anyway. It's not clear whether she was. But even if she's just doing tax work, she still has a problem.
okay. Well, let me jump to Jill now. And I want to talk about this in a silo still. We're just talking about the accounting issue, the accountant's issue, and what your firm. First, let's talk about how does Moglia Advisors get involved in a case? Who usually makes that phone call to your group, and how does your group start to get involved in a case or a potential case?
Thanks, Judge Hagan. There are several different ways we will get involved in a case. Most of the time, it does come from a legal referral. It'll come from a bank referral. And there are times when we have had referrals from the UST themselves in a situation like this.
And when you say UST, that's the U.S. Trustee's Office, in
Yeah,
case
the
anybody
United States
is non-bank trustee. Okay, so let's assume you receive a phone call from someone within Acme and says, you know, we've just discovered this about about Sarah. What would your team do in considering pursuing
Well,
some professional liability?
It would be more in terms of, we'd be solicited to come in the case. I don't think we'd come in looking at this so much as we'd be looking at it if we were to become a receiver. They'd be looking to put us in place. And if we were going to go into this as a receivership trustee, we'd be looking at all the different angles on where this, what this situation has created. And we're looking at it in terms of how to maximize a creditor's return on their claims. That's what's our primary responsibility as a receiver or a trustee. And so we have to kind of look at this from a cost benefit analysis and look at what kind of a return we would get if we were to, and in the past we have gone after law firms, and we have gone after accounting firms and gone after their insurance carriers, suing for damages. We probably would start at the point of under legal counsel, looking at preparing a demand letter, looking at the situation, and if the cost benefit looked reasonable that we could collect something for the creditors here that was worthwhile, we would look at our legal counsel to help us draft a demand letter. The demand letter is not quite going where we want it to go, then we start the possibility of maybe a mediation to try to settle. And if it is still something that's not getting us anywhere, we do get to the point where we will sue for a liability here.
Okay.
I would caution every person, whether you're a lawyer or an accountant or a financial advisor or whatever position you're in, your engagement letter is, in the end, can be your best friend. If you have multiple clients, and even if everybody is happy, even if everybody's in the same family, you still need to talk about what happens if their interests diverge, because it could be as simple as two people wanting to take very different tax positions. You need to be clear what happens when that happens, because it saves you a lot of trouble and also helps you when Jill comes knocking on your door.
All right, well, I'm going to jump over to the attorney side, and then I'm going to go back to Jill after we hear from Judge Barnett and talk a little bit. But Judge Barnett, what do you think John's next steps should be, considering this fact or this hypothetical scenario?
Well, I believe what John should have done, and he attempted to do it, but he didn't quite follow through based on what we know. What he should have done was to follow up with Ronaldo shortly after that conversation to make sure that Ronaldo ended his relationship with Arts Plus and disclosed and make sure that Ronaldo disclosed that relationship to Acme. And to the extent that Ronaldo did not do that, then John's next step was to escalate that to the CEO. And if the CEO did not act, escalate it to the board. And the reason for saying that is that John is under an obligation under the ethical rules that govern lawyers, specifically Rule 1.13b specifically requires attorneys for organizations who know an officer acting or an employee acting in a way that would harm the company for that lawyer to take action that would minimize the harm to the company. In terms of taking action, the rule essentially makes clear, and you can go to the comment section of the rule, which is comment 3 of Rule 1.13b, it makes clear that if a lawyer knows that the organization is likely to be substantially injured by an action of an officer or other constituent that violates the legal obligation to the organization, or act in a way violation of the law that could be imputed to the company, the lawyer must, and I emphasize must, proceed in a reasonable, necessary.
And what do you think is reasonable? And I would assume that this needs to be in writing, but when, let's say that there's somebody on this call today that has this scenario, when would you say it would be reasonable timing to disclose?
Timeliness is, and comment number 5 of Rule 1.13 talks about timeliness to the organization. It's important that the organization immediately know what's going on so they can take whatever steps necessary to mitigate the problem. We don't know how long Ronaldo has been conducting his side business. It could have been for months or years, but when John found out about it, I would say he should have, he did take some step by telling Ronaldo to stop it, cut it out, and report it, but he should have followed up with Ronaldo to make sure that actually took those steps. And I really wouldn't have given Ronaldo a lot of time. I probably, next business day, if I were John, I would go ahead and reach out to Ronaldo and inquire whether he made efforts to inform the company. And if not, John himself should have informed the CEO, or if not the CEO, the board of directors of what Ronaldo is. So a month later, when John found out that the lawsuit exists, I suspect that he can argue that he didn't know about the extortion portion of it, so he didn't have all the facts, but the side business was going on, and it was his obligation to make sure that was known to the board as well.
Let me jump in here and let Locke jump in and have her tell us if John does nothing, or let's say that it was too long, what should John be concerned about? His professional liability, and can you give us some details on that?
Absolutely. And I think that Judge Barnett hit the nail on the head whenever she was referring to the substance of Rule 1.13, because of course the rule requires that John report this Ronald's conduct to his client, which is Acme, within a reasonably necessary period of time. And I think we can assume that he did not report it because he learns 1 month later of the lawsuit filed against Acme by Parts Plus. I think it's probably pretty standard that waiting 1 month would not be considered communicating that in a reasonably necessary amount of time. I agree that the 1 business day would be a better approach, and failure to report the conduct of Ronald to Acme could also come back to really bite John, because under Tennessee law, there are cases that hold that a relationship between an attorney and a client is a fiduciary relationship in its character, and that an attorney is held to the utmost good faith and in the discharge of his duties to the client. That case is Fitch versus Midland Bank and Trust Company. It's a Tennessee Court of Appeals case from 1987 that is routinely cited in more recent case law. So I think John should be put on notice that Acme might have a claim for a breach of fiduciary duty from John to Acme, as John should have recognized that Ronald is not John's client. He may be John's friend, but Acme is John's client. And under Rule 1.13E, John really had a duty to let Ronald know on the front end that Ronald was not John's client. the rules of professional conduct also indicate themselves that a duty of loyalty exists between an attorney and the client. Rule 1.7, comments 1 and 13 both impart that duty of loyalty from an attorney to a client. And I think obviously John runs the risk of a RPC violation because Rule 8.4, of course, notes that it's misconduct for an attorney to violate the rules of professional conduct, which I think if John fails to report this conflict to Acme, he'd really be running afoul of his duty to report that.
I'm probably going to come back to you here in a minute, Locke, but I want to get Jill involved here. And now that you've heard both John and Sarah's issues, and let's say that you've been hired now, I think that when we did a prep talk on today's CLE, you talked about a similar case that you may have, and so I just want to kind of hear from you and on about that case, and then maybe it will prompt some other discussion of things that people should be thinking about in the process of while they're trying to cover themselves.
Well, we do have an active case right now, and I will just share briefly and just let you know that we have a case where we're in a state where they have a Homestead Act. And what the situation is, this is a case where there's a company who's in bankruptcy, and their law firm, one particular partner, was not only representing the debtor, but also the owners personal, several of the owners. And there were several very detailed emails going back and forth between the main owner of the organization and the law firm, detailing how to evade if you should go into bankruptcy, evade the creditors by hiding your funds and putting them into your home to keep the creditors at bay. So those kind of things do happen in real life. We can attest that is something that we are pursuing with that individual situation. But it's not always an easy situation. We started with a demand letter. We've been in settlement. We're in mediation, but we are suing as well. And it will probably not get much further than in the settlement stage and mediation and have to go to court. The opposing side, the legal team, the legal counsel, they will try to use imperi delicto to try to defend themselves in this situation. So that is something we have to overcome, and we're going to try to do so. That happens, it's happened in several cases we've had where we have gone after and sought damages for the law firm. We have also sought damages in other cases with the accounting firms as well. And it would not be unusual for us to maybe consider some kind of damages, and we would be looking at Ron and looking Ronald and at his part in this whole thing. I mean, he started it in the first place. When we talk on all 4 of these sessions about fraud, certainly when you define what fraud is, he definitely is, what his actions are here fall under that. He is deceived, he's committed a deceptive act for his own personal gain. He's extorted money from Acme by using his influence and his title in the company. So that would be another area we would probably be looking at, and we have done that in other cases as well.
Locke, let me jump in here. So I know we've discussed this prior, but you know, when you think you're sending an email that is that you are probably going to mark as a privileged document because it's attorney-client privilege, but you're sending it to potentially somebody that is not really the client. And those are the emails Jill is really interested in. I don't know if you really looked into this very much, so I may be putting you on the spot, but talk to me about that. What is discoverable potentially that is an email, and should people think about some of the emails that they're actually sending that they believe may be privileged but actually aren't?
Well, I think as far as if you're communicating, I guess you'd have to look at the nature of the communication in Jill's situation, where if the law firm is representing the entity but was communicating with the owner of the entity not in connection with its attorney-client relationship with the entity, I think you could really argue that there's a disconnect there, and that you should be entitled to discover that communication because it's not related to the engagement that the law firm was hired for. They were hired to defend or advise the company, and they're advising the owners on how to maybe squirrel away isn't the appropriate term, but it seems like they might have been trying to squirrel away.
Throw it away. They did.
I mean, as a general rule, you know, I think if you have to give some thought to this, it's like I said, it's not unusual for lawyers to represent, particularly small companies, to represent the owners and the company. But when things get dicey, when I was in private practice, I mean, I represented a lot of owners where larger law firms called and said, we have this problem, we need outside counsel for the owners. But before that, where are you sending that email? If you are sending that email to the company email,
Right.
and Jill takes the privilege as the receiver for the company, yuck. If you're going to send that kind of thing, you ought to be sending it to a personal email as the attorney for that
Right.
person, because otherwise, if you're sending it to the company, it's the company's property, and you're going to have a hard row to hoe to say that is privileged, even if that individual was your client as well.
We had a situation where we were in bankruptcy. We were representing the estate, and we identified a conflict, and so we helped engage another counsel to take on that one piece of litigation or that one issue. And the thing that wasn't thought about, which I pointed out to our corporate lawyers, was the fact that every email that you're sending to that other counsel, that is discoverable. And so you need to think about who might be looking at that email and taking it out of context. And I'm not helping Jill in her job, but you know, if you think about that a little bit more, then maybe it's not as clear of a picture for Jill to come after, let's say, the lawyer that potentially may be liable for some sort of breach of duty. But not that I'm encouraging that in any way, but Judge Barnett.
Judge Hagan, in some of our conversations in preparing for this webinar, we talked about how, as a receiver, we will look at insurance policies. We will ask for insurance policies from the law firm, the accounting firm. And what was interesting, because we're in Tennessee speaking with all of you fine people in the state of Tennessee, is that you all mentioned that we wouldn't be, as receivers, able to request that. Locke, can you speak to that a little bit?
Certainly. There is a case in Tennessee. It's the case of Thomas versus Oldfield, and that case site is 279 SW 3rd 259. And it's an opinion from Justice Holder. And I think in the opinion, she opens the door for for Tennessee to adopt that the rule that is basically in federal jurisdictions in most other states that insurance policies are discoverable in the discovery process. But the way the Tennessee rules of civil procedure for this state are written now, there is no recovery or you cannot require that the other party produce insurance policies. And it's in the opinion, she talked about Justice Holder went through, sort of the federal interpretation of the rule and so on and so forth. But the fact that in the case, it was a medical malpractice case, and the plaintiff had requested that the doctors and the hospital produce their insurance policies. And the court ruled that the insurance coverage was not going to be admissible at trial because it wasn't relevant to the negligence of the doctor or lack thereof and the hospital. So, but I do think that the Supreme Court of Tennessee opened up a door for someone to jump in and try to revise or amend that rule, but it has not been done yet. So if you're in Tennessee, I think you can't get the insurance policy unless you can somehow finagle a way to show that it's going to be relevant or it leads you to otherwise admissible evidence.
I think that if that would probably apply in state court, but I would think that the federal rules would apply in bankruptcy court, and that would be a little more favorable to the receiver than the state court rules. But state court receivers are going to be bound by that.
Exactly.
I think that we have a observer that wants to jump in. And so Alex, I think you might want to comment on this insurance issue. So I would be pleased to hear from you.
Thank you, Judge. Just briefly, Jill's mentioned something that triggered a thought. We were involved at our firm as assignee for the benefit of creditors in a state where the assignment statutes don't exist, in Illinois. Unlike most other states that have statutory guidance on assignments for the benefit of creditors, which are very similar to receiverships. And in that case, we didn't have much money in the estate. We were the assignee, but we uncovered a number of wrongdoings by the principal of the business, who, by the way, gave rise to the hypothetical covered in one of the panels last week. But we didn't have money, but we had a fiduciary duty to notify the creditors at a minimum of the wrongdoing and to notify the errors and omissions carrier at a minimum of the actions of the principal and sole owner of the company. So what we did as part of our fiduciary duty, again, outside of a court proceeding, nevertheless, a trust was created, the assets were placed in a trust, and we had to sell and administer those assets, liquidate them, and make a distribution to creditors, which we did. However, what we did is we wrote a report, a forensic report within our firm. We are a financial firm, and we notified the creditors of the wrongdoings of the principal in writing, and then sent that report to all the creditors, great and small, detailing the wrongdoings and the findings of our internal investigation about the very principle of the company. We also sent a copy of that report to the insurance carriers and put them on notice that although we were not going to pursue the claims against the principal because we just didn't have enough money in the estate, and we didn't want to burn the money in the estate for pursuing litigations with an uncertain outcome, we put the carriers on notice that the creditors had received that same report and that the creditors should expect contacts, the carriers, the insurance carriers should expect contacts from those creditors seeking to pursue the principal on their own dime and making a claim on the insurance policy. Some of them looked at the actions of the principal, those creditors. They chose not to spend more good money after bad because of the uncertain outcome of all litigation. But at a minimum, we had the fiduciary duty to share our findings with the creditors because we had to do what's right and we wanted to have a clear conscience as fiduciaries. That's
And
what.
in that case, Alex, I believe, and you had mentioned this, we had little or no money to even
Correct.
pursue that. And in
Correct.
that case, that particular person was blatantly abusing the company's credit card, even though he was the owner, but he was running an enormous amount of money, personal expenses through his credit card. And we, in our writing of our report and presenting that to the creditors, told them that as such. But, we're always, in whatever kind of case we have, an ABC, a receivership, or a trustee, we're always looking to maximize the benefit to the creditors and always looking at that. We're not doing this just to completely go out there and go after everybody. We're looking at it, pursuing something based on the fact that here's the amount of money we have left in the case, and if it's worthwhile to go after it to bring that money in to the assets of the estate.
That's
If
right.
you are,
Jill,
if
because
you
it's
are
an
being
economic-
approached, if you're being approached by a receiver or someone, and you honestly believe that you might have some liability, and you are the small fish, and they really want the big fish, it behooves you to settle a little
Yes.
earlier,
So
because they're
true.
likely to take a little less money from you to fund going after the big fish.
Yes,
But after they've gotten litigation financing, all bets are off. So you should
Yeah.
probably try to figure out, if you really think you're going to get hit with something, get hit early, get out early,
Yeah.
because they'll take less money usually in the beginning because they need the money to go after the person they really want to go after.
so true, Susan,
In this,
so true.
in this scenario that Jill and I just discussed, this guy even charged his daughter's wedding costs.
Yeah, I
on the
wasn't going to
company
mention
credit
that.
It was a
but,
marketing event.
Yes.
He used it for marketing purposes. He invited all his clients.
Well, since I rushed us along because I thought we were ending at 4, I want to go back to Judge Barnett. Judge Barnett put in the comments a case, and maybe we have time to discuss that case if you're prepared for that, Judge Barnett.
Well,
So-
I wanted to mention 2 cases. One was, should be in the material, the Whitney Group LLC versus Hunt Scallon Corp et al. In that case, it's a case out of New York. It's actually a New York State case. In that case, both cases involve attorneys being sued for not informing the board about what's going on. And in both cases, the attorneys who were sued tried to get the case dismissed, on various grounds. In addition, they also both these comparative negligence type defense. And in both instances, the courts in both cases did not dismiss the underlying complaint, and also stated that the comparative negligence defense doesn't really work, because even though the company could have done more to protect itself, it does not excuse the attorney from his or her responsibility under the rules. So the case that I put in the comment is a very interesting case. It's very detailed, but what it reminds us of is how simple that a malpractice cause of action is. It's a tort. You have about 5 elements. You got to establish attorney-client relationship. You got to establish that there's a professional duty that arises from that relationship. That duty was breached, and it was approximate cause of the injury to the company and their damages. And in the Antioch litigation trust case, which I put in the comments, the chat section, that involved a firm, an attorney who was representing not only the company, but two of the major shareholders of the company and board of directors, who wanted to retain control of the company. And he represented them through a variety of different scenarios, including creating an ERISA plan that turned out to be not a good plan, and ended up, the company ended up having debts as a result of the ERISA plan. From their debt increased from 11 million to like 200 million in a time span of a year. And he continued on to represent the company and the principals of the two members of the company. And eventually the company was placed in bankruptcy. A litigation trust was created. The bankruptcy didn't work out too well. So after the bankruptcy was over, the litigation trust sued the law firm. And one of the cause of action included a malpractice cause of action, and the attorney, the firm, was trying to get that dismissed.
So
After
looking at this scenario, I wonder if there's any piece of advice you'd give professionals in order to avoid similar situations as described. And maybe I go to Jill first, since you're the one that chases after people. What has stopped you from chasing after some people? That you've
Well,
seen?
what has probably stopped, usually doesn't stop us. We'll chase after, like in the case of the example that Alex just provided us, we didn't have enough money to chase after that. But we have a strong sense of right and wrong here in our organization. And so when we're looking at these things, we'll pretty much go after most everybody as long as there's a cost benefit to the creditors. I also think that as the company, Acme, they should be a little more proactive, and any company to prevent something like this. You have to have a little bit of ethics in place within your company's organization. And I just wanted to speak to that a little bit. And an ownership needs to be in a current case we're in right now, where we're trying to save a company from going into any kind of receivership. There's clearly was no ownership directive. This owner has stepped back and has washed his hands, did not want to be involved in the day-to-day operations. And owners need to be involved in their organization. And if they're not, then they better have really solid people that can do so. An active and present role in running the company, having an ethics agreement that you have your C-suite group of people sign off on. And not only just sign off on it, really practice that and trickle that down to the entire organization, so everyone knows this is how we behave here. And what Ron was doing is not appropriate. And really, also the segregation of duties, shame on Acme for letting Ron be having such a direct line without someone else in there, like a sales rep or something that might have been involved. To keep the segregation of that and not allow him to have such a free reign and terrorize this other organization.
As a practice pointer, if you represent a company like this and you're putting together the manual or the employee manual, most employee manuals will say, "Thou shalt not invest in or do business on the side with length of number of people." So I would think if you were putting together a manual of any sort, it would say, "Thou shalt not do first of all, most of them all say you will devote all of your business time to us. But if it doesn't say that, it's certainly going to say you shall not create conflicts for us. So you will not do business or invest in our suppliers, because one, that's kind of insider trading. If you know stuff about your suppliers, that's kind of a problem. And second of all, you've created a mess. So, you should have an employee manual that says thou shalt not.
Yes, agreed. And then it's not just enough to have the manual. You have to get it out there and make sure it's being practiced, and everybody just doesn't put it on the shelf where it gathers dust for years and years and years. It has to be applied and everybody is reminded of it. And that's in the actions of the ownership and the actions of your managers and your directors. And everybody's accountable to each other.
I've worked at several firms where you have to at least annually sign under, not necessarily penalty of perjury, but you do have to sign a statement that says you are aware of all the provisions of the employee manual and you are in compliance. If Ron had to do that, and he was, you protected the company a little bit, you've also created a cause of action for the company against Ron, because not only is he doing something wrong, he's doing something against policy. And it could also protect you against the in peri delicto defense, because he was clearly acting outside of the scope of his authority, because there was a policy that said he shouldn't do it. He couldn't do it. So that will help you if it comes down to you suing Ron in some kind of in peri delicto situation.
What kind of barriers can you put up if, let's say, you are a younger lawyer just starting out and you see this as a client relationship, but you're confusing the client relationship with the friendship? What tips would you give a younger lawyer when it comes to that?
Who are you directing that to, Judge Hagan?
I don't know. I'm looking at Locke, but it may be advice for Locke. So we'll go to Locke first, and then maybe we can all give her additional tips.
The one good thing about the virtual is that you can't ever tell where you're looking, so you can't ever tell what's being called on. Excellent question. I think, and so often, especially whenever you're working on client development, you're trying to make these personal connections with clients so that they feel comfortable with you as an attorney-client advisor. And so it is, I can see how John and Sarah the lines can get blurred, especially when you know each other in a social setting, or especially if that social setting started before your business professional relationship. But I do think that it's important to recognize who is paying your legal bills, and you have an obligation to that client. And if you can't recognize that client, I think, and you want to keep the personal relationship, I think you have to resign from that client engagement. And I don't know if I'm answering your question that you're asking, but it's a very fine line, because we want to be trusted advisors for our clients. We want the business as much as they don't want to have to hire an attorney. But I do think that you have to still have some sense of awareness as to who your duty of loyalty lies with. And if you have a problem telling Ron, look, you messed this up, and you've got to go tell Acme. I think Susan said it the best: friends don't put friends in this situation. And so I can't be involved with it anymore, because as we all know, when you're an attorney, you've only got your name, and that's about all there is to it. So
and the same is true for accountants. I got a call maybe 6 months ago from a client with a kind of a WTF kind of thing, where the younger accountant who had been helping the CFO on things had kind of forgotten that the client was not the CFO. And the CFO was involved in some internecine warfare with another C-suite person, and the accountant was helping them draft memos, and it's like, no, we don't do that. And that is something that you need to kind of regularly remind people about, is who the client is, particularly the younger ones who are trying to develop their practice and develop these relationships, because they want to grow their own practice. And it's easy to start to conflate the contact with the client.
Oh,
And
sure.
that's really where a lot of these problems come in.
I think if you're a young associate and you run into a problem like this, hopefully you'll have a managing attorney that you're working with that you can confidentially talk to, and talk and sage advice. Most young attorneys, you're probably not going to be the attorney person who's doing the most work.
You're cutting in and out, Judge Barnett.
Oh, okay. Now it's saying that, can you hear me better now?
Yeah.
Yes.
Okay. So I said, as you know, depending on where you are in your journey, it may not be your client, but you are doing the most work in the case, and you're hoping to establish a good relationship with that client contact. But you probably would want to immediately talk to your supervising attorney or the managing, or that the firm is not exposed to a problem.
And if you're leery to do that, because a lot of junior people are, most state bars, I know the AICPA does, I know certain of the CPA organizations do, I know the Georgia Bar does, have ethics hotlines where you can call and get a confidential walkthrough of, holy crap, what do I do now? So if John is in a firm where he doesn't have a lot of people to talk through, or where Sarah is in a firm where, it's her firm and there's really nobody she can really talk to about what should I do, the answer may be to call the hotline. I know when I was researching this, a lot of the AICPA guidance says when you get into these problems, call your lawyer, which is something I highly recommend. But those hotlines are there for a reason. And if you need somebody to tell you whether you really, kind of what your duties are, they're there to help you.
So we have a few minutes left, and I just want to remind everybody there'll be a poll that will pop up, and so please answer that poll as quickly as possible before it disappears. And then if you have any questions for us, I'm checking the chat. I didn't say that at the beginning, but you're welcome to ask any questions, and I will happily read them aloud to everyone. But I really do appreciate everyone's time today. This was an interesting topic. I also, since we have a couple minutes left, and I'm going to put Judge Barnett on the spot. So my favorite thing about bankruptcy is this rule called disinterestedness. And if you're not disinterested, then you may not get paid in the case. And so I always feel like that was always my standard of, is this kosher? And if it's not, it's because there might be a disinterested issue. And so Judge Barnett, just for the last couple minutes, if you can talk about that standard, that'd be wonderful.
So disinterested, 327A of the Bankruptcy Code has a two-prong test for deciding whether someone can be a professional for the bankruptcy estate or the debtor. And one is that you cannot have any adverse interest to the estate, which is more of a conflict type standard, and then you get into or potential conflict. Now, disinterestedness is the second prong, and that's a more stringent requirement. And that stringent requirement talks about any connection that you may have that could impact your duty of loyalty to the bankruptcy estate, to the debtor. And that heightened requirement is less, it's a stricter standard than any of the bar rules that exist. Layered on top and in addition to the bar rules that exist. So there's a whole theory and reason for the creation of that two-prong test, but obviously you're dealing with a distressed company and you don't want a professional further advantage of the distressed nature of the company or of the individual debt. So because of that, in Chapter 11 cases, as well as if a Chapter 7 trustee were to employ professionals, you would have that heightened and stricter standard of disinterestedness. And it is defined in the code. Section 101.14E talks about adverse interest and talks about the nature of the things that the court would look at to make sure a person is not disinterested. You want to, the best way I can describe it to just, just to everybody is to make sure there's no connections whatsoever.
Mhm.
And that connection is not just an insider connection. It could be an informal friendship or relationship.
Like
where
this situation, like this hypothetical.
Yes, exactly.
So neither Sarah nor John are getting hired in the bankruptcy. They're both out.
They're both out. That's correct. There are cases out there, even, there are even cases out there that talks about, who is an insider. An insider obviously would be a person who would make the professional not disinterested. And those cases go in informal relationships like boyfriend-girlfriend relationships, friendships, that pre-existing friendships that exist, just any kind of connection or relationship that would impact a person's ability to exercise a fiduciary duty to the client.
Okay, well, I think that we've hit our time. We're actually a minute or two over. I really appreciate everyone's time today. I don't see any additional questions. And so thank you for joining us in this last part 4 of a series that Alex probably put this on. Him and Chancellor Jenkins put this together along with their team of people. And so excellent job, and hopefully everyone learned something.
Well, it's been my pleasure to work and meet all of you. And thank you for all of your hard work. It's been a joy.
Thank you for inviting us.
For inviting
Thank you,
us,
guys.
appreciate it.
Thank you.
Thank you.
Bye-bye.